Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This is a podcast from HSBC Global Research, available on Apple Podcasts and Spotify. However you're listening, analyst certifications, disclosures, and disclaimers must be viewed on the link attached to your media player.
Hello from HSBC Hong Kong. I'm Fred Neumann, Chief Asia Economist.
And I'm Harold van der Linde, Head of Asian Equity Strategy. You're listening to Under the Banyan Tree, where we put Asian markets and economics in context.
So China and the US have reached a trade agreement, for now at least. Today we're asking, does this signal an end to the standoff between the world's two largest economies, and how far does the saga still have to go?
Much to discuss, so let's begin. From HSBC's Global Research, you're listening to Under the Banyan Tree. Let's start with a quick recap of the US-China trade deal. Reciprocal tariffs have been paused for 90 days. The US is rolling back tariffs on Chinese goods to 30%, while China is cutting tariffs on US goods back to about, say, 10%. Both sides say they want to prevent decoupling, and discussions are set to continue probably for the next few weeks at least. So, Fred, what's your take on this?
Well, look, this is very positive news. Markets are reacting positively, and very few people had expected that so quickly after the escalation of tariffs, you're going to see some sort of a rapprochement between the two sides and a big cut in tariffs. But here's why we need to keep things a little bit in perspective. The first thing to say is this reduction is really only for 90 days, and we still need a more permanent agreement. Now, it seems likely perhaps that we get this.
Yeah, the language seems to be very constructive, right?
So the language is very constructive, but it's not a permanent agreement, right? So that's one thing. The other thing is that this is only about their so-called reciprocal tariffs. There's still a whole other bucket of tariffs, which are sectoral tariffs. So the Trump administration, for example, has said it would impose tariffs on auto imports, semiconductor imports, pharmaceutical imports. They've already imposed tariffs on steel, for example. So there are certain categories where we might still see higher tariffs come through. And then, of course, there is also this issue that China said we're going to get rid of non-tariff barriers, for example, but it's not really clear what that is. There's no real kind of set of deliverables that came out of this. These are broad kind of intentions of negotiating principles, but often in these negotiations, really the devil's in the details. Yeah. And so you might see a bit of friction, prolonged negotiations come back. But, we don't want to be too negative here.
The mood is good.
It's better than it was a week ago, right?
Yeah.
We've taken a step back from a very, very prohibitive level of tariffs. And also what's good here is that it kind of raises the specter that maybe other economies, which still need to negotiate with the Trump administration, also therefore might have a path to maybe less punishing tariffs than we first thought. So the hope might be here that pragmatism prevails, that there's more negotiation, and ultimately countries will come to a sort of agreeable settlement with other
I think the
economies.
timing here is a bit of importance as well, because we know that a lot of companies found ways to deal with the tariffs for the moment. For example, some of the larger retailers, we spoke with Paras, our shipping expert, a lot of the retailers have actually taken, I wouldn't say delivery of the goods, but they brought in goods, but put them in bonded warehouses in the US, hoping for something like this to happen so that they actually could restock their stores very, very quickly. So the disruption to the supply chains at the moment is not so big yet, but if this would have continued, then of course all sorts of these warehouses would be full. So you can't do this.
So that's interesting. Yeah, it means that maybe we had these tariffs for 5 weeks, 4 weeks, 5 weeks, 6 weeks, depending on which tariffs you look at, and maybe the disruptions are manageable for the U.S. economy and for the world economy at large. But there is an element here, I think, that the entire episode has injected a lot of uncertainty into trade policy. And what matters here for the business community, of course, is predictability, right? If you start to invest in a large factory, put $1 billion down to expand your factories, and you don't know whether the rules of the game might shift very quickly, then you're more hesitant to deploy the cash.
That's right. But I think there's even something bigger going on, because just before Liberation Day, U.S. bond yields, the 10-year benchmark, stood at 3.9%. That's what the U.S. government was asked to pay for issuing a loan for 10 years. Now it's 4.4%. So that's gone up a lot. That's quite a lot, actually. That is not all just inflation. My suspicion is this is exactly what you mentioned. There's a risk element now being attached to the decision-making process that is involved here.
That could be, right? So uncertainty in itself, investors don't like uncertainty, and so they always demand a premium, if you will, for extending loans, and be it loans to the U.S. government or otherwise to companies. And so what you might see is higher risk premia in financial markets. And you mentioned the U.S. Treasury market, and it might be for the trade reasons or other reasons that actually the market is demanding now, for the time being at least, a high risk premium. And that, of course, then impacts also even equities in Asia, right? That's the U.S. risk premium going up. But why would that impact then how investors in Asia should think about it?
Everything, to be honest, actually, everything in the world, every financial asset is priced off that 10-year bond yield. That's the alternative that people look for. What can I can put this 10-year into the government, and then, hey, how does that work? And what is the alternative that I have, and what additional risk do I take into invest in equities or property or anything like that? So that's a negative. But I also think for Asia, and particularly for China, there's a kind of an offsetting effect as well. I think that the tariffs, they get a lot of attention. If they would have combined the policies that they put in place, tariffs, with something like that. So on one day you say, we're going to impose these tariffs, and the second day you say, we're going to make any company that invests in these particular technologies in the US tax-free, or we're going to give all kinds of grants, or we set up a research institution, whatever you do. That could have been a very powerful combination. That hasn't happened. And China is increasingly taking leadership, or is very close to catching up with the US.
I think economists would even argue that, yes, there is a trade imbalance between the US and China, no doubt about it, and it's probably not sustainable, at least politically not sustainable. But to fix that, it's not clear that tariffs are necessarily the best tool to do that, because the source of the imbalance lies in the respective domestic economies.
Yeah, one consuming too much and the other one producing too much.
And the consumption in the U.S. is very high, and it's partly because the budget deficit is very high. And in China, it's too low. And so actually the way to resolve this is not to use tariffs ultimately, but it is to fix the domestic imbalances in both economies. But that, of course, entails difficult political decisions. And so it's easier to revert back to tariffs because that's easier to sell. But look, maybe
actually, just to hook onto this very quickly, these imbalances need to over time be rebalanced, but it hasn't hurt the US or China, right? I mean, China has seen reasonably good economic performance, and the US as well. It's done better than, say, Europe or Japan. So it's not that this is an immediate sort of stress, I would think.
It's not an economic problem that you have this imbalance at the moment, but there's a political reality.
That's true.
And so you can say imbalances have reached their political constraints before they're reaching their economic constraints. But that political reality is what it is.
It is
so
what it is.
That's what
that's
you
right.
see that come in.
That's right.
But Harold, maybe this is a good time to take a break. And when we come back, I want to ask you about the market reaction, particularly here in Hong Kong, which I find actually striking to what has been very positive news. Maybe the market reaction wasn't all sort of hurrah around Asia as one would have thought. So, Harold, before the break, we talked about big picture, about this phenomenal trade deal, and that, obviously is a positive element, certainly compared to a few weeks ago. We've really seen at least for 90 days, a lot of reprieve. Now, many equity markets around the world have taken this initially very well, but the enthusiasm kind of faded very quickly, at least at the time of recording. We saw, for example, the Hong Kong market, which is a proxy for China, actually being bit down on the day after the announcement. Shouldn't investors have been more excited about such a view? Why is this skepticism suddenly coming back in?
So I think there's a couple of reasons for that. First of all, the market responded very rapidly when the news broke. It was actually in the afternoon here in Hong Kong. And I remember literally seeing it on the screens and watching my Bloomberg screen, and the share prices started to rally within seconds thereafter. Bang, it went up very quickly. So some of it was already priced in. So the day after, the new reality sets in. Secondly, what we've seen over the last months is that money has left the US. That's that kind of risk premium that you spoke about. Has left the US and went into other parts of the world, Europe and the emerging markets. But as we now normalize a bit, that returns. So the dollar strengthened a bit, and that's normally not so good for Asia. So that's another effect that is in place here. So those two probably helped out, and we still have 30% tariffs on Chinese products. That's still quite sizable. If we would have announced this on Liberation Day, people would have said, well, that's very, very high. It's just that we come from a much higher level now. So these issues probably play a role. Also, global investors are still very underweight, but the regional investors, which have really been active in the last couple of weeks, they were already overweight on China. So it's not that they are buying that much more. So that's probably a third reason that I would throw in there as well.
So the market reaction has been very quickly kind of faded for these various reasons you mentioned. But as an economist looking more at fundamentals, is that also indicative of the fact that we've maybe made too much of the tariffs, that actually there are all these other underlying factors that matter quite a bit and they haven't been resolved? So yes, it's better, we have slightly better news on tariffs, but really the big one for Chinese equities is what happens in the domestic economy. And so that's just, kind of stuff on the side, the tariffs.
Exactly. And I think we get sometimes too much caught up in the news flow, but it's the seen and the unseen. It's a quote from a book I've seen once. We look at what we see in front of us, but we also have to look at the stuff that you can't see. So what I mentioned, for example, the absence of policy in the US to slow down China in these technologies means China can go ahead. But that's not something that's being discussed. And on the margin, I think that's positive for China. But that's not something that's being discussed because there's no news flow on this. So too much attention probably has gone to tariffs.
But I have the perfect solution here. If the news flow, if people just monitoring the news flow with too much attention to the here and now, they should be listening to the Under the Banyan Tree podcast, because there we put Asian markets and economies in context and we really provide the underlying picture. Tune out the noise and subscribe to this podcast.
Well, that's a wonderful way to finish it off, Fred. Thank you very much for those very wise words. And I hope people would listen to us next week again.
Well, we're going to have to wrap it up here, folks. Great to have you with us under the Banyan Tree, as always.
Yeah, and with those very wise words of you, Fred, you can follow us and get more on this global tariff story by listening, liking, and subscribing to the Macro Brief, our sister podcast from London.
From all of us here in Hong Kong, take care, stay well, and we'll see you again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.